It's been 60 days now since the US and Israel attacked Iran, which closed the Strait of Hormuz, creating the largest oil disruption in history, affecting markets across the board, including precious metals. And there's been a lot of noise and a lot of fog in the markets as a result. But in this gold market commentary for Friday, May 1st, 2026, I'm going to pinpoint for you exactly what has affected precious metals the most directly since early February, so that you can anticipate how this may continue to affect precious metals values going forward for the next several months. Hi, I'm Dana Samuelson, president of American Gold Exchange in Austin, Texas. We are a national physical precious metals dealer. If we can help you with any of your needs in the physical precious metals arena, we'd love to have that opportunity. In this gold market commentary, the Iranian war has become a stalemate, with Iran blocking the Strait of Hormuz from the inside and the U.S. blocking Iran's oil exports from the outside, which has created the largest oil supply disruption in history. Meanwhile, as I've promised, I have identified and I will explain to you gold's most significant and direct driver in the market since early February and how it transmits into precious metals pricing. Meanwhile, inflation is gaining momentum, not a surprise. And I'd also like to speculate just a bit on what could happen over the next couple of months based on what already has happened. So let's get into our update. International Energy Agency head Fatih Birol testified in Paris this week that we now have the largest oil supply disruption in history, creating the biggest energy crisis in history. This is an article from MarketWatch that I found on April 30th, 2 days ago, where JP Morgan estimates that oil supplies may hit a breaking point if the Iran war lasts into June. And while there was a nice cushion of oil available, 8.4 billion barrels in storage, of that, only about 800 million barrels are really material as a shock absorber to the supply interruption that we've seen so far. And that we could hit stress levels by June the way the Strait of Hormuz closure is going right now. Let's dig down a little bit on that. From the article, it estimates that the supply loss as of March 31st, the total cumulative supply loss, is 360 million barrels. In my last update from April 17th, I estimated that was now 531 million barrels. But as of 2 days ago, JP Morgan has upped that estimate to 800 million barrels of supply loss. But mitigating that, as the price has risen, that has created some demand destruction, which as of a month ago, JP Morgan estimated was 2.8 million barrels per day, rising to 3.7 million barrels per day 2 weeks ago, and 4.3 million barrels per day now. So lower demand is helping to create an extended cushion of supply. But JP Morgan estimates that this will come to a halt sometime in June, the way things are going. And we're seeing that in the oil price, of course, which has spiked since the conflict started. This is a Brent crude oil chart that goes back 1 year. Oil was trading between 60 and 72.50 before the conflict started. Brent crude punched up to $112.57 at the peak before the ceasefire was declared, fell to $90.38. But now, as the stalemate continues, we're back almost to the peak at 111 2 days ago, closing out the market today at about 106. We're seeing something similar in the West Texas Intermediate crude, trading between 57 and 66 before the war broke out, peaking at 112.96 when the ceasefire was declared, bottoming at 83.85, and now running back up to 106.88 as of 2 days ago. Today, WTIC is closing at about 102 and a quarter. So still over 100 with the bottom at about 85. So that is oil higher for longer. And what is that doing? Well, that is moving treasury yields around. And what's most important to us is the 10-year treasury yield, which is the benchmark for interest rates, not the federal funds rate, which is at 3.64%, but the 10-year treasury yield, which started the war at about 3.95%, punched up to 4.4% on that first oil run higher, came back down to about 4.22% as the oil price softened. But now, as the oil price has risen again, it's punched back up to 4.4%. So yields are responding to anticipated inflation. With inflation rising due to higher oil prices, bond investors have been selling bonds, which causes the yield to rise. Why would you want to hold a bond in a rising yield environment, which if you have a bond at a lower yield, say 4%, and the yield goes to 4.4%, your bond is going to be worth less than newer bonds that have a higher return on investment. If the oil price starts to rise again, investors will start to sell those bonds, pushing the yield back up. So this is the relationship between bond yields and anticipated inflation caused by the rising oil price, the falling oil price, and then once again, the rising oil price. Bond yields have moved pretty much in direct response to oil's surging higher, falling lower, and surging higher again in anticipation of inflation. All the while, the federal funds rate has held steady at 3.64%, which is where it stands today following the Fed's meeting this week, where they left rates unchanged. But there's been a changing of the guard from Jerome Powell now to Kevin Warsh, who will be coming in as the next Fed chair, who's expected to be pressured to hold rates lower, not higher, from President Trump, of course. And if we drill down on a 3-month candlestick chart of the 10-year treasury yields, bond yields were sagging from 4.3% to 3.92% going into the start of the war that occurred at the bottom at 3.92%. Then as the oil price surged, the yield surged up to 4.48% on that high candlestick wick. Then as the oil price sagged, yields softened down to 4.22% on the 10-year treasury. And then over the last couple of trading sessions, as the oil price peaked and then softened a bit, they hit 4.4%. And today they're closing out Friday at 3.8%, where I've penciled in that dotted line, which is not reflected on today's chart yet. So you can see how the yields have moved pretty much in response to the oil price changing. Conversely, if we look at the gold price, you can see an almost direct inverse mirror image of those yields. Going into the start of the war, from February to February 28th, the gold price was rising in anticipation of the U.S. military buildup. But once the war started and the oil price really started to surge in response and yields surged, the gold price was pressured lower. When the oil price bottomed, gold bottomed between 40.98 and 4,300, and then rose as yields fell back to 48.91, and then has been pressured back down again over the last 2 weeks as yields have risen back up. It's a direct inverse relationship to bond yields. That's what's really driving the gold price and silver, platinum, and palladium more than anything else right now. And I expect that to continue as time passes. If we put these two charts side by side, the 3-month 10-year treasury yield on the left and the gold price on the right, you can see the direct inverse correlation of this relationship. Gold doesn't offer a yield. So if yields are rising, it makes gold less attractive, helping to pressure gold down when yields rise, and vice versa. And you can see it's almost perfectly direct on a day-by-day transactional basis. Now, I've taken the 10-year treasury yield and I've inverted it. And now it sits side by side next to the gold chart. And again, you can see an almost direct correlation on a daily basis between the gold price and the yields as they've gone up and down over the last 3 months. This has become the most direct driver of precious metals values since early February. And I expect that to continue to be the case going forward. There was a correlation with the dollar, but that's been broken over the past couple of weeks. So typically the dollar's inversely correlated to precious metals, but right now yields are the most dominant driver of precious metals values. Here is a 6-month candlestick chart of gold, which shows the two parabolas that I've indicated on the 3-month chart that we were just looking at. So you can see how the 50-day moving average and the 200-day moving average are becoming very material with regard to gold. When gold took the big tumble lower just before President Trump paused the military action, that was when the threat of annihilation of the Iranian infrastructure was in play. That caused the biggest sell-off in gold down to 40.98, which touched on the 200-day moving average at that point in time, which has now risen to just under $4,300, where I see major support otherwise. On the top, we've got the 50-day moving average. And when gold surged in the second surge higher based on yields falling, it brushed right up against the 50-day moving average before the rally stalled at 48.91. Now, today we've got the 50-day moving average coming down a little lower at 48.35, and we've got the 200-day moving average continuing to rise as they narrow to 42.60. So real support for gold is going to kick in between 42.60 now and 4,300, where I see previous support with upside resistance at about 48.35. Today we're closing the market at 46.20, which is right in the middle or just about at the equilibrium point between the two. But the most dominant driving factor for gold going forward will be its inverse correlation to the 10-year Treasury yield, in my opinion. So that's what will keep the most eye on going forward. We're seeing something very similar in the silver market. You can see the two parabolas that I've shown. Again, silver took a big tumble just before military action was supposed to really ramp up against Iran, and silver tumbled to 60.94 before Trump paused military action. So that's our bottom line support, $61. And that's concurrently right about where the 200-day moving average is. Right now, the 200-day moving average for silver is at 62. That's the red line with the little red circle at the end of it. Contrarily, the upper resistance level is going to be the 50-day moving average, which we did get over for a bit 2 weeks ago. And that's right when we did our last update. But since then, the metal has tumbled down a little bit with the rising yields. And we've got the 50-day moving average right now at 78.40. So I see resistance at 78.40 and then again at 82. Equilibrium right now is about 72 with a bias to the support there. We're closing the market today right at $75.75 with support under 72 at 66 and a major support at 61. Now, in addition to that, we've got this rising blue trend line, which goes all the way back to before silver went turbocharged last fall and into early this year. And that trend line puts support today right at about $71 an ounce. So I think that's another important trend line for silver. And we've moved over that as we are getting close to testing it 2 trading sessions ago. So this is where I see support and resistance for silver. And again, the most direct impacting factor for gold and silver will be their inverse correlation to Treasury yields. Going to the gold to silver ratio chart, I did this a little bit earlier today when silver is just a tad higher with gold at 46.20 and silver at $76. That brought the ratio at 60.78 to 1, or just about in equilibrium, where gold and silver are in fair value relative to each other. So I think if you're interested in investing in gold or silver, you should consider equal parts of both based on the ratio today. That's how we use the ratio to see which metal might be more valuable relative to the other. Going back 25 years, we see the equilibrium point at about 62.5 to 1, and we're just a hair below that right now. Looking at platinum and palladium, we're going to see something very similar with the two descending parabolas of trading action. For platinum, we have the 200-day moving average at 1810, which is just a whiff above that support level that I've got at 1800, and upward resistance with the 50-day moving average at 2065, which is about $100 under where it peaked 2 weeks ago when the yields were at their lowest point at 2161 for platinum. Now we are edging up against more towards the 200-day moving average today. So platinum is showing a bit of strength over the last couple of days, a little bit more than gold and silver relative to the price action that we've been seeing. We're seeing something similar in palladium. I see support at 1375, firm support. The 200-day moving average right now is coming in at 1485, about $108 higher. We've gotten under that a couple times, as you can see, with upward resistance at 1615 in this last cycle, which was right where the 50-day moving average was at that point in time. Today, the 50-day moving average for palladium is at 1585. So these are the points for you to consider for precious metals going forward. Moving on to inflation, we're seeing the Fed's preferred inflation guide, the PCE, surging in the last month, up 70 basis points from 2.8% to 3.5% for headline PCE inflation, which is expected. This chart goes back to the inflation peak that we saw in 2022 when inflation peaked at a little over 7% for headline PCE price index. I do think we're going to see this index head closer to 5% than not, with the core probably going more sideways to bias to the upside. But the headline PCE price index, I think, is probably going to end up getting closer to 5% before this is over. So inflation is going to be higher for longer as well right now in the next few months. Now, going back to where we were with yields in the federal funds rate in 2021 to 2023, when we went through that last big surge of inflation, I want to compare then to now. So let's take a quick peek at the federal funds rate then, which went from virtually 0 to 5.25% at that point in time when the Fed went into a significant rate hiking cycle. All during that phase, the 10-year Treasury yield hovered pretty much between 3.5% and 4.25%. So if the 10-year Treasury yield is just a little higher today than it was then, but the Fed really ratcheted rates a lot higher for the Fed funds rate to combat inflation at that point in time, which I don't think that they can do or will do now. Why does the Fed raise the federal funds rate? To create demand destruction. And the oil price rising so sharply over the last 3 months is already doing that. Right now, I believe the Fed is neutered because raising the federal funds rate will have virtually no impact whatsoever. The opening or closing of the Strait of Hormuz or the price of oil internationally, or the supply and demand of oil, which is really the most dominant factor in the world, as I said it would be once the war started. So the federal funds rate's at 3.64%. If anything, I expect it to hold steady and probably go lower as time passes, because I do think the higher oil price will create headwinds for the U.S. economy, and the Fed will probably be forced to lower rates, which will be a tailwind for gold as time passes. But that won't happen for a little while. I think we have potentially some headwinds for precious metals over the next couple months because of the higher for longer oil price. Here's that West Texas Intermediate crude chart again. Oil has held above $85 for the last 2 months. And even if the Strait of Hormuz were to reopen tomorrow, well, we'd see a knee-jerk sell-off. But the fundamental 800 million barrel supply deficit has really yet to hit the world market pricing. And I think that's going to hold up oil higher for longer, which could help to hold yields up higher for longer and perhaps push yields on the treasuries higher still a bit, which would be pressuring the precious metals markets. So we might see one more modest sell off in precious metals, which might give us slightly lower bottoms than we've already seen for gold and silver in earnest. For silver, that's around $65 or $66 an ounce. And for gold, it's about $44.50. It's possible that could happen. It's also possible we may restart kinetic military action against Iran to bring Iran to the table, because it's possible that the only thing the Ayatollah and the clerics and the Iranian Revolutionary Guard Council understand is force. And that may be what's needed to bring them to the table so that we can achieve our goal, which is to deny Iran of a nuclear weapon. That is the stated goal of the military action. And we're a long ways from achieving that goal. And that's the last thing that Iran wants to let happen. In fact, the new Ayatollah said just 2 days ago that they would protect that like they protect their borders. So I do believe that we'll probably see military action perhaps sooner rather than later, which could create an oil spike, which will translate into yields higher, which will translate into precious metals being pressured. I think that's probably likely. How much and how long is anyone's guess. And today it was reported that Israel may consider going alone without the US if we don't decide to do that ourselves, go after the nuclear material in Iran. So here's the yield chart once again. So you can see we've peaked at the 10-year Treasury yield twice now at 4.4%. We could get back up to 5% for Treasury yields. And if that were the case, that would pressure precious metals lower. But I do think at some point in time, value shoppers will come in and buy the precious metals dips. Plus, we're going into summertime, which tends to be a little bit quieter for precious metals, and they tend to be a little bit more vulnerable to pressure. But once we get towards the fall, there could be potentially a lot of tailwinds for precious metals. So I would look at any new dips in gold and silver as major buying opportunities going forward. That's how I'm going to look at it. So that's my update. If you're interested in physical precious metals, here's a QR code that'll take you to our Getting Started guide that explains the most widely traded, competitively priced, and for you, easily sellable precious metals products in the marketplace. This is what our website looks like, where we have those very same products in live, online, transparent pricing, very competitive pricing. And we have specials. Look for the little red dollar sign. Right now we have a special on backdated 1 ounce US gold eagles and MS64 $20 St. Gaudens that are trading at the same premium as bullion gold eagles. They've got a lot more potential upside than gold by itself through potential premium expansion. 15 to 20% more potential premium over their 10-year average right now. That's a good value if you're interested. Here is our social media accounts where you can follow us between updates. We post regularly on Twitter or X, LinkedIn, and Facebook. And we update our YouTube channel with these updates. Thank you for watching. Please subscribe. Here's what our YouTube channel looks like, of course. And here is our contact information. So thank you for your time today. I hope that this information will help you understand what's happening in precious metals more effectively going forward for the next couple of months at least. So this is our 28th year in business. Thank you once again to our loyal clients for the loyalty and trust that you've placed in us over the last 28 years. Without you, we wouldn't have a business, and we are grateful for your support and business every day that we are open. So thanks again, and good luck out there.